What's up, everyone? It's Scotty with MoneyVest. So this is going to be your macro update on the markets. We're going to take a look at our entire intrinsic value spreadsheet, basically going over the market technicals and also talking a little bit about valuations and where we are with our volatility spreadsheet, what percentiles we're on, and more importantly, the money market funds that are sitting for institutional and retail investors, which have now been going down a little bit. So they've declined by about $16 billion in the week ending in January 17th. And I believe this week it's also going down a little bit further. That simply means money is now rotating out of money market funds and into other assets as well, which is why exactly I believe we're seeing such incredible momentum higher for equities, for stocks that are hitting new all-time highs. The NASDAQ composite still a little bit away from all-time highs. I do believe that it's really eyeing for that all-time high on the back of semiconductors and chip stocks. So hope you all enjoy this video and find it helpful. As always, make sure that you drop a like. I would really appreciate that, and subscribe to the channel if you haven't already. The links to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members only private videos, getting access to all the spreadsheets that I'm going to go over. You will have access to all those, and of course over 20 plus Discord channels, including trade alerts, buy and sell alerts, options alerts, trade ideas. Everything's going to be included, and there's a couple more spots left with the 16% discount that expires at the end of this month. So first things first, let's quickly break down the money market fund assets. This is as of January 18th, 2024. And we did see the total money market fund assets decrease by about 14 billion to just under $6 trillion. So this right here was the change. And a lot of that's coming from institutional, right? So retail, we actually saw an increase of $1 billion. Institutional going down a little bit, close to 17 billion. And again, that number coming down from 5.96, or actually 5.975 trillion to $5.96 trillion, which again was at a very, very extreme level. So if you come over to our this chart, total money market funds, you'll notice that we are still sitting at a 4.5 times the average median number, basically the median over the last several years, over the last 40, 50 years. And you can see that we're pretty much sitting at a record high at almost $6 trillion still sitting on the sidelines, which of course is a pretty big deal considering how much money is still sitting on the sidelines waiting to be deployed in the markets. Now, this right here is our S&P 500 valuation spreadsheet, and where we are right now is 48.96. This does take time a little bit longer to update, but if you come over to SPX, where are we right now? 48.95. Okay, so pretty accurate. Another new all-time high at just under 4,900 right now. So that's exactly where we are at 4,900. And the earnings expectations, of course, at 225. So 2023 PE multiple, we're still sitting at 21.76, a little bit under 22. And this again is going to be updated once the entire 2023 earnings are done, right? So right now we don't know what the earnings are going to look like because the earnings season literally just got started for the fourth quarter fiscal year 23. So once we have the entire earnings for 2023, this number will update. Right now we're sitting at just under 22 times earnings, and right now the earnings yield, which is simply a reciprocal of this number, we're sitting at 4.6, because if you do the math, 1 divided by 21.6, so if you do 21.76, we're looking at a 4.59%. So basically you round that up to 4.6%. That's the earnings yield on the S&P 500. Now, this is what causes the risk premium, the equity risk premium, to go down, because if you consider the 10-year yield and where that is right now, so the 10-year yield has also been rotating back higher. So it's at 4.14%. So now what you do is you take 4.6 minus 4.14, 4.15, and you get down to 45 bips, 45 basis points. That's the premium that you're getting for taking on additional risk by investing in equities versus bonds. So I hope that makes sense. That's the equity risk premium, which of course has been going back and forth. It's come down to near zeros. It's gone up to 1%, 2%. It's been negative also at some point because the markets were really overvalued and the yields were as high as 5%. So the earnings yield was really low compared to the earnings yield on the dividend yield or the yield on the 10-year treasuries, and that's why it was negative. So it's been kind of back and forth, but right now we still have a little bit of that premium. Now, according to Professor Demodran at NYU, this is one of the approaches to calculating their equity risk premium. But according to him, he also kind of factors in the earnings growth and understands, okay, that the growth is going to be this much plus the dividend yield, whatever that entire potential yield is going to be on the S&P 500 is what needs to be taken into account. And then you subtract that with the 10-year treasury yield, and that's your actual equity risk premium, which according to him, I think is still above 2-3% right now. So according to him, of course, according to a lot of the analysis done around equity risk premium, one can argue that there is still premium for investing in equities versus bonds. But if you go the conventional, the more traditional route, then maybe there is very very little premium left right now. So what you'll notice, of course, the market cap is concentrated in between top 7 stocks, so 29%. 7 largest companies as a share of S&P 500 total market cap, and that's not happened in over 43 years or something. 29 close to 30%, so a third of the entire market is controlled by just 7 stocks. So what that basically means is 7 divided by 500, we're looking at 1.4. So 30% of the entire S&P is controlled or influenced by 1.4% of the stocks. Just think about that concentration here in just a minute. Now, what equity risk premium looks like is compared to government bonds. Stocks look at their most expensive in 2 decades as well, is what they are talking about. So again, the 10-year treasury yield versus the S&P 500 current earnings yield, that's exactly what I went over. So we've got a very, very, very small gap here. You can barely see it. It's not even there right now. So let me see if I can point it out. So that little gap you see right there, that's the 45 basis points that I just went over in the analysis that I just went over here in a minute. But of course, you'll notice that we have been higher for the longest time, and that gap has, of course, been at some point also been negative. So you can see that when the yields were above 5%, right? So that blue line is above the black line. So that earnings yield was lower than the 10-year treasury yield. That's why the equity risk premium was negative, and it's back down to lower levels. But of course, since the yields have also dropped, it's still a positive number, but by a very, very small margin, right? So 45 basis points. But for the longest time, of course, you'll notice that this has been the entire gap where it has been positive. So this white blank space you see, that's the positivity between the earnings yield and the 10-year treasury yield. And the last time you actually saw that reversal was back in right after the dot-com bubble bursting. This was in 2000s, like early 2000s is when we saw the 10-year treasuries yielding more than the earnings yield on the S&P 500. So that, of course, is a little bit of an issue. If that happens again, well, then so be it. Then, of course, liquidity is going to move more towards bonds again, because there's not enough incentive for investors to be investing in equities versus bonds, because there's not a lot of premium. Now, this right here, cash looks so much better now. So even though there is some institutional movement out of money market funds over to other parts of the market, cash still right now looks to be a little bit more king, because the spread of the S&P 500 dividend yield over 3-month treasuries is still pretty solid, and there is a negative 4% right now. Looks like 2022 peak was really high, because if you come over to SPY, the dividend yield on the SPY is going to be at 1.37%. And let's just come over to the 3-month treasury, and 3-month treasury is sitting at 5 point. Wow, that's a pretty big spread, right? So 5.375 minus 1.37. So 5.375 minus 1.37. We're looking at over 4%. And that's exactly what this chart basically represents. We're looking at 4%, right? That's where we are. So that again is levels we haven't seen since, I believe, 1990s or early 2000s. I believe that spread was so wide, and that's really where we are at the moment. That's why this Bloomberg report suggested that cash is still king right now, as compared to other areas in the market, especially equities. So where does that leave us? From a valuation standpoint, there's no doubt that the markets are, I would say, somewhat trading at a premium a little bit compared to their counterparts when we look at bond markets. And bond markets, of course, are still, there is no uninversion that's happened yet. Spreads are still negative. We still have, the negative 20 basis points on the 10-2. If there is any recession expectations, if there is any weakness in the overall economy, then of course there's possibility for the yields to once again start moving lower, for interest rate cuts expectations, and for this uninversion to happen, and that spread to once again turn back positive for long end of the curve yielding more than short end, and for S&P to also kind of react in a way that's not going to be so great, because earnings expectations could start to deteriorate over the course of 2024. But that being said, as I mentioned before, those are all predictions, right? Those are all sort of making predictions or trying to predict what's going to happen. I like to look at the analysis. I like to look at the focus on the markets today, on the present moment, and assess where the risk reward is. And right now, I can tell you that this is a market that is not, in my opinion, worth buying into. This is not a market that I'm aggressively dollar cost averaging into when it comes to individual stocks, because the valuations are high. When it comes to the broader based market ETFs, no problem. I'm personally dollar cost averaging, keeping up with that frequency, whatever that is, once a week, once a month, once every few months, whatever that dollar cost averaging plan is for myself, I'm going to continue with that. And considering where we are from a risk analysis and where the volatility is, simply looking at selling calls to hedge potential downside, if there is any, for the markets to rotate back lower. Because we know there is going to be a time when the markets do roll over, because there is RSI overbought, MACD's overbought, technically we're overbought, there's overextension, valuations are a little bit more, trading at a premium. So we know it's going to happen. We just don't know when, right? That's the key difference here, is that it's going to happen. We just don't know when. And that's exactly what I'm prepared for. Now, when the markets do pull back, let's say we get a 7 to 8% drawdown, or we get a 10% correction, or about 12-15% double digits, then I'll start deploying cash funds again. And I'll be very much focused on finding good deals and dollar cost averaging into the markets once again. Because like I said, it is much easier to time a bullish reversal than it is to time a bearish reversal. Timing in general is not a good idea, but if you were to do it, bullish reversals are much easier to time because generally markets are trending upwards, as we have already seen with a very nice recovery back in 2023. And of course, that's going on in 2024. So hope you all enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below. And again, if you want to get access to all these spreadsheets that are going to be available for you, you can access them and view them at your own time. Link's going to be down below for you to join. And as always, happy investing. And I'll see you all in the next video. That 16% annual discount that does expire in about 6-7 days. Again, link's going to be down below. Happy investing. I'll see you all in the next video.